explain the purpose of the framework, how it defines elements, and why might these definitions be criticised. To my way of thinking, that is three separate questions. What is the purpose of the framework? What is the framework? How does it define the elements, which is a knowledge regurgitation? And then, why might these definitions be criticised? So maybe I'm thinking 333, because I'm being asked three separate questions. It's about analysing the requirement. Then there are three other parts to the question, something about a lease, something about a property, something about an issue of a financial instrument, and for each of the transactions above, we've got to explain how it would be accounted for in accordance with IFRS. Then we've got to discuss whether that contradicts the framework or not. And presumably that is 15 marks, 555. So this is how you should account for it, this is how the framework suggests, and then there's a little bit of a debate. No real numbers can be crunched there. Maybe I might make up some numbers, but no real numbers can be crunched. The conceptual framework describes the basic concepts that underlie the preparation, that underlie the presentation of financial statements for external users. The framework serves as a guide to the board in developing future IFRSs and as a guide to resolving accounting issues. This is useful stuff. There is an exposure draft out which discusses potential changes to the framework. Forgive me if I talk more than I actually write down. So I will produce a series of kind of bullet points or ideas, and you know the style of the exam. You would be looking to write 3 short, sharp sentences. Is the framework a rule or a principle? Principle. So the framework is in its... Let me do all the talking first, then I'll summarise it. The framework is basically a foundation. The framework is basically a set of principles on which the accounting standards are then built. So the purpose of the framework is to facilitate a principles-based approach. Your accounting standards can only be principles-based if they're based on principles. Yes. So the framework is the base, the theoretical foundation on which accounting standards are built. By having a framework, we should achieve, in theory, we should achieve coherent and consistent standards. Because if you have a blueprint, if you have a map, if you have a set of values, if you have a set of principles, then the way that you formulate your laws, formulate your rules, conduct yourself will be coherent and consistent. I believe that we want to have good financial reporting. If we have bad financial reporting, capitalism won't work. Capitalism depends on companies being able to raise capital, the investors having a faith and trust in the financial statements. Now, for the market to have faith and trust in the financial statements, several things must be present. First of all, we must have good accounting standards. The Wall Street crash in America in the 1930s happened because there were no accounting regulations, and suddenly everybody was cheating and they realised the financial statements were not reliable, so they sold the shares, and it brought about a major world economic recession, and we only really got out of that because of the Second World War. So the market, the world, woke up to, yes, we must have accounting regulations. Because unless you have accounting regulations, financial statements are not reliable or comparable. The other thing that you need is to have honest, ethical accountants. Because there is actually no point in having good accounting standards if your accountants are crooks. If your accountants don't know what those standards say, or if your accountants, when they are using their judgment, use their judgment in an unethical way. So we've talked about ethics and how ethics is so important, yeah, in the application of judgment and in the application of accounting standards. If we're going to have good accounting standards in a complex world, they have to be principles-based. If they're principles-based, you have to have a framework. So the framework is massively important in a conceptual way, in a long-term way, not on a day-to-day way, but in a philosophical way. By having principles, you have better standards. By having better standards, you have better financial reporting, providing you're not dealing with crooks. So the purpose of the framework is to provide this set of principles. So when the International Accounting Standards Board is creating new accounting standards, reviewing accounting standards, it will do so in a way which makes them coherent and consistent and better. Blah, blah. Blah, 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 blah. I mean, it has other little purposes as well. Sometimes we have a situation where we don't know what the right accounting treatment should be. And if you don't know what the right accounting treatment should be, because there isn't a specific accounting standard on the issue, or there's an interpretation, one of the things you can fall back on is your core values, your core principles, go back to the beginning, and therefore try and resolve out whether or not, how you should account for things. It's also argued that it helps users understand and auditors do a better job, and it just kind of, whatever. You mustn't say, the framework is boring. You mustn't say, all this theory is a waste of time. No, you want to pass the exam. Yeah? So, its role is strategic. Its role is long-term. Its importance is high from that academic perspective. As a practicing accountant on a day-to-day basis, you're not looking at the framework on a day-to-day basis. It's like the constitution of a country. That if you're going to have good laws in a country, in theory, you have laws in accordance with your constitution. So the constitution sounds a bit airy-fairy and impractical, but by having a constitution, then you have better government, better legislation, so on and so forth. Blah-de-blah-de-blah-de-blah-de-blah. So, what is the purpose? What is the role of the framework? It's a set of principles on which accounting standards are built. It's a blueprint. It's a map. It's a foundation. It's an influential document. It's a set of principles on which accounting standards are built. It is influential. It will mean that we have coherent and consistent and principles-based standards. Life is too complex for there to be black and white, rules, rules, rules. Financial reporting is full of judgments and full of matters that require guidance rather than prescription. So the framework is good that our accounting standards are principles-based. Good that our accounting standards are principles-based. It means that, so the framework is influential and will help us have coherent and consistent principle-based standards. It will help us solve accounting issues in the absence of a specific standard. So we may have a scenario that we have not particularly come across before. There is no accounting standard, and you would be able to work out the right accounting treatment. For example, staff would not be assets of the company because staff are not controlled in the normal sense of the word. The purpose and the role of the framework, I think, is primarily to provide a set of principles on which accounting standards are built. That, for me, is really the strategic, most important thing. That by having the principles, it influences standards, so standards become coherent and consistent with each other, so you don't have an ad hoc solution to an ad hoc problem. You've got a coherent approach. It will help us solve accounting issues in the absence of a standard. It'll help the users and the preparers and the auditors understand the role of and the limitations of financial reporting. Blah, 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 blah. I'm sure there's a couple of marks there that you can get out of a discussion. It's important. You have to say the framework is important for that strategic role. Now, strictly speaking, there are 5 elements in the accounts. Strictly speaking, there are 5 elements in the accounts. Assets, liabilities, equity are found on the balance sheet, and in the P&L we have income and expenditure. Now, these 5 elements are important, but of the 5 elements, 2 of them stand head and shoulders as being the most important, because the philosophy of the framework is to worship assets and liabilities. The philosophy, the theme, the principle within the framework is that we always try and adopt an asset and liability approach. So the definition of an asset, the definition of a liability are central to financial reporting. Measurement issues are all over the place because we have a mixed measurement system, and the framework doesn't prescribe that we use cost, and the framework doesn't prescribe that we use fair value. So some standards use cost, some standards use fair value, and it's a mess. Agriculture, anyway, let me stick to the definition of an asset and a liability. I'll go off track in a minute. Definition of an asset. Key. Something that you must learn. Here it is, 1 mark, bish bosh, for regurgitation. An asset is a resource that you own. No. An asset is a resource that you control. So So control is key to the idea of what an asset is. So an asset is a resource that is controlled as a result of a past transaction or event, and is going to give us a future economic benefit. There is going to be a future economic benefit. There is going to be an inflow of cash. Or there's going to be you are going to be better off because of the existence of this item. Now, normally you can think of being better off as having cash, but you could be better off because you've developed some kind of software, and that software will save you costs. So you can capitalize revenue expenditure on an intangible asset of development that gives you benefit by saving you costs. But so economic benefit in a cartoon way is cash comes in. But it means that you're better off, and you are better off if you're going to save costs in the future. So an asset is a resource that is controlled as a result of a past transaction or event with a future economic benefit. A liability is a present obligation as a result of a past transaction or event, the settlement of which will result in an outflow of economic benefits. Money will go out. You have a bad situation. So it's a past transaction. The settlement will result in an outflow of economic benefits. Money will leave. Money will leave. So assets are good things. Assets are debits. Non-current, current, intangible, tangible investments. They can take many forms. But what they've got in common is you control them. As you know, you don't have to legally own the asset for it to be regarded as an asset, because under a finance lease, the legal title is not yours, but you still recognize it as an asset because you've got substantially all the risk and rewards of ownership. You control that asset, you've got the benefit of it. Now, equity is evidence of an ownership interest. Equity is a balancing figure. Equity is assets minus liabilities. Equity is evidence of ownership. If you own a property, and the property is worth 100, but your mortgage is 80, so if you own an asset, and your assets are 100, but the liabilities are 80, you would say the equity is 20. You don't set out with the equity, you set out to measure the assets, you set out to measure the liabilities, and the equity is a byproduct. The equity is a function. The equity is a balancing figure. The equity is rather unsatisfactory because it is bullied by the definition of an asset and the definition of a liability. Yeah? So equity doesn't really stand up on its own 2 feet. So equity is a balancing figure. It's the difference between assets. A stands for assets, L stands for liabilities. This is your accounting equation. Takes me back to F3. Yeah? It is evidence of an ownership interest. Now, recognition criteria has to be probable and measurable. So if we're going to recognize an asset or liability, if we're going to recognize an asset or liability, there has to be a probable flow. There has to be a probable flow, and it has